A warm welcome to everyone who's joined us this Sunday morning for this long shot webinar. And we are really trying to get out what I think is the truth. After all, we've always tagged ourselves about the truth about the markets. And this is a moment of truth where hopefully for a lot of people, as we start crossing the borderline, the conviction about what is going on in the market really starts to grow, because so far uh, there's a clear divide between people who are nicely sitting back and participating in one is what has been the start of the next phase of this bull market, uh, and this next phase, meaning the first phase was of course after 2020, and the next phase is now starting 2023. And then there's the divide because a lot of people have been fearful based on the news flow, which is very typical because that's how markets operate. They sometimes climb a wall of worry. And the real truth to me was in being able to compare with a meaningful multi-year bull market that we've all experienced in the past, which was between 2001 to 2008, and come to the conclusion that uh, history does not repeat itself, but it often rhymes, right? It's a much quoted line from Mark Twain, and holds very true with markets. When we do financial market analysis, history is our best guide. We have to look back years or decades to figure out what happened in the same situation before, and then try and draw conclusions into the future. But what happens in making those taking that guidance is that when you do find similarities, you also find dissimilarities, and that's where the job of a market analyst gets tough, where he has to be able to connect the dots in what is really going to happen because of the similarities, whether the similarities are the stronger point and the dissimilarities are essentially the smoke screens that confuse you in believing that this is exactly the same. And that's where studying the environment, knowing what is really going on, taking a step back, looking at the macro picture is a big leap in getting that confidence. And I've sort of been confident most of last year that it would eventually unfold in this way. The only mental debate was what would be the depth of the 22 correction before you took off into the next wave of the bull market. It could have been steep. It didn't end up being steep, and I think because it didn't end up being steep, a lot of people were set back on why it didn't end up being steep, and therefore have waited long enough for something to show them the green light that yes, there is no more trouble on this road. And I think a lot of those green lights are flashing right now, which is why I say that it is a moment of truth for all of us. Now, what also can happen in the process of studying history is that uh, we can actually end up uh, going to the wrong place, or missing out on something, and by the time we wait for a confirmation, as it says here, the damage is already done one way or the other, either on the upside or the downside. The damage is done because the best risk rewards are actually lost. That doesn't mean that you can't participate in a market, but you'll always be a little fearful and you'll always be slow in doing so. So with the use of wave analysis and sentiment analysis, a lot of the tools which are now available for everyone on the Strike platform that we have just launched, which is all my sentiment indicators that I have been looking at historically to take these contrarian calls, are now all available with historical data on the Strike platform, which makes it easier for anybody and everybody to go look and act accordingly. Of course, wave analysis is something that you cannot really program, which is why it still remains something that we have to humanly derive based on price and market action to come up with the best probability that the market is really offering us. But when we combine all of this, when I combine wave analysis with sentiment, we are able to act at a time when the risk reward is favorable, even when it's not all blue skies. There are still some clouds on the horizon, but we get a sense that this is the time to take action because when you're at a market low or you're at a market high, the news is never going to be favorable of a contrarian position. And the judgment call therefore has to be based on a lot more data. You just cannot talk to your five friends and say, well, everybody seems to be bullish and therefore the market will peak out, or everybody seems to be bearish and the market will bottom out. You have to look at what the market wide positioning is, what everybody is doing, the entire crowd, right? After all, we're trying to study crowd psychology, and when we talk about taking a contrarian stance, we're really talking about taking a contrarian stance to the crowd, which is the market as a whole. And therefore any sentiment data has to be market wide data, whether it is put call ratio, whether it is advanced decline, breadth. I want to see breadth across all the listed securities, whether there are 3,000 stocks on BSE more than there are on NSE. I actually like looking at that as my breadth rather than just the 1,200, 1,500 stocks that are listed on one exchange. So that's how I think about breadth. Even when it's put call ratios, people like to think about only Nifty. I like to think about the market as a whole, and that makes a lot of difference in the way I study sentiment and data, and put it together. And so when you reach that point where things are at an extreme, and the wave structure also gives us a setup where something can turn, we like to take a stance that this is the right time to turn bullish, make an entry, and then figure out things along the way, because you don't have all the answers uh, at all points of time, but you do have enough information to take action, and action is what finally determines your outcomes. So taking action is really, really important. Believing in your analysis and your data is really, really important. And so we don't really wait for, it's all blue skies. And now I'm sure, because by that time those risk rewards which we can actually detect using sentiment and wave analysis can actually put us way, way ahead of the curve. So that's sort of been the way I've approached this market, and the way we approached it when it hit 15,200 a year back in June of last year. If you go back and see the long short report, the long short webinars are live. They're free to watch. In case you don't know, the weekend with India charts, everything which is more than 6 months published on India charts actually becomes free to view. So if you actually go back and look at last year's webinars where I and Chavan are having a debate on, should you even turn bullish at 15,200? My answer was that even if you think it's a bear market rally, you should get invested, because by the time you reach 17,000 and 18,000, your view might change and you'll not get to buy at 15,200 again. And that sort of and that verdict, that answer that I gave him ended up becoming true to the word, because you've never gone back there. And when we came back to 16,800 in March, we pretty much thought it was end of cycle, because I had an idea that consolidation phases or bear markets in India last for a typical plus or minus 18 months. Of course, they've gone to 21, they've been 15, but 18 was like the mid average, and a lot of comparison was being made with Y2K, which was also 18 months. So starting up with March of this year, ending an 18-month consolidation, what I've called it is the resumption of the bull market. And this slide now here goes on to explain what I'm saying, why I'm saying, and why you should have been able to see it. And if you have not seen it, then you can probably see it even now, because we have a lot more confirmation coming in from the currency and bond markets in the last couple of weeks, or last couple of months, which is why I say that this is the moment of truth, as many of those, trends are getting confirmed, which we have been anticipating one at a time, slowly but surely getting confirmed. And so what is the big picture? The big picture is that the last serious multi-year bull market was 2001 to 2008. The period after that was a long consolidation, and at least in continued to have a boom in things like consumption and the BFSI space, and a lot of the defensive space, which is the FMCG, IT, and so on, but not in the core economic cyclical sectors. They all went on a backdrop because of excessive investment in the previous cycle, and this is what always happens. I mean, you can go back and see the same pattern all the way into 1994, 1995, where a lot of overinvestment led to excessive, debt. A lot of NBFCs went down. There was a reset, and that reset took 8 to 9 years, and then you restarted a new cycle after 2001. So we went through that reset, 2008 to 2020, And from there, we've resumed what can be a multi-year bull market, which is far more broad-based, not involving only a few sectors, but almost every other sector of the economy starts kicking in, flashing green signals, and taking off. So that is what we have to really expect in the years ahead. I think 2020, when I wrote the reflation trade, I think in May of 2020, that this is the start of a reflation trade. What we were looking for was essentially that after many years of consolidation, many of these key sectors break out. And when we make comparisons of that to 2001, the only variation we see is that what happened between, say, 2000 and 2001, right? You had the tech bubble, and then you had the tech collapse, which is sort of what we witnessed between maybe 2000 and 2021 as well. But this is where we say, history does not repeat, but it rhymes. So I'll go over what I just said with charts a little later, but let's just look at the similarities. Okay, what really makes the investment environment the same? You have cyclicals breaking out of 10-year consolidation zones now that we've seen by 2021. Various sectors, whether it's power, capital goods, real estate, all started to emerge from those 8-year, 10-year consolidations. The leading sectors like capital goods, power, and metals have already gone to new all-time highs, okay, in 21 itself, and then they were pulling back from there, doing some kind of a retracement. Now we'll consider why that retracement didn't end up being deep, or whether it's necessary or not. And on the other hand, you have even PSU, for example, doing that this year. It didn't do it last time. It got to the breakout point, stopped there, but now the PSU index, if you open it, was also breaking out. It's almost touching, I think, the 2008 high. It's very close to breaking out a few more percentage points, and it's done. And then you have emerging sectors, like I've written manufacturing here, the Make in India sectors, which are the new emerging ones, many of which are newly listed. You have defense, where you had only a BL earlier, and now you have many others newly listed from the government side. So those are the emerging sectors that get, those which got listed at, I can say, decent valuations compared to the new age tech, which got listed at extreme valuations. There's a huge difference between how the two happen. Something that we'll also reflect on a little later, based on, I can reflect on that now as well. If anybody has a memory of PSU banks, when did a lot of the PSU banks get listed? Andhra Bank, Union Bank, they all got listed at the end of the last NPA cycle, the non-performing assets cycle of the 1990s. When that business cycle went down and PSU banks had a lot of NPAs, 10%, 15% of book. Yeah, it was like that. It was very similar to what you saw this time. But many of the banks were not listed, and they all got listed after a lot of write-down had already been done. They still had the NPAs, but the NPAs had been written off, provisions had been done, so there was nothing else to lose there, and dividend yields were very high, P ratios were very low. So these were value stocks which were at the end of an NPA cycle, but they were just newly listed. The important part is that when you get newly listed at a decent value, what ends up happening is discovery, okay, which means the value is still not discovered, unlike the new age companies, which are bogged down by high valuations and lack of discovery, because all the discovery was done by the private equity markets, and now you're trying to participate in whatever is left over. That is how I think about it. But here you are looking, the PSU banks were discovery in 2001 because they were all newly listed and the market hadn't owned them yet. And same with some of the metal stocks like Analco, which had just been around for some time. So therefore, they moved up much, much faster at that point of time in terms of price appreciation. The same you're seeing in defense, right? Newly listed companies like BDL or Hindustan Aeronautics, which has become, center stage of the sector now. These companies were only listed in the last few years and have gotten a lot of attention since then, which is the discovery really happening for a sector, because they didn't get listed at 100 P, right? So that is why discovery is happening. So the main point being that you have a lot of sectors which start to boom, starting off new cycles after 8 to 10-year consolidations, which is what makes the start of a cyclical boom and a bull run. And the only thing between that is, okay, do you get a wave 2 retracement? I think that was the only concern in 21-22, and the hope probably always is that, oh well, if we get a deep wave 2, because second waves have a historical tendency of being deep, then we could get lucky. But what also happened during the similar phase is, and I mentioned the NPA cycle, right? The NPA and corporate debt cycles ended in 2001, with a lot of the debt being written down, a lot of the companies being unwound, even the Jindals got their debt converted into equity from the banks, and so a lot of those things happened back then. Uh, and by the end of the 2000s, there was no shakeout left to happen. You were really at, in fact, you can actually say by 1998 the value buying started with the tech boom. A lot of these core sectors went through their first waves of that bull market. Okay, but the broad theme which was common, okay, there may be some behavioral differences between what happened in the 90s and how it happened in the 20s, but in the 2010s, that is. But it was the end of an NPA cycle, end of a corporate credit cycle. Okay, and then government policies kicked in from 2001, whether it was the golden quadrilateral, spending on infra, but the power sector policy and so on. All of that aided a fresh cycle for a lot of these sectors, which means government support kicking in, government spending coming in a way that drove the debt to GDP up from some 70-80% all the way to 90%. And then from there, the baton shifted from the government to the private sector. Okay. So government stepping in, kicking off a capex and infra cycle, along with falling interest rates. So interest rates fell from late 1990s all the way into 2002, from what was double digit, bank rates or bond yields to single digit. I'll show you charts of all of this. So I'm just giving you the backdrop, and why it is similar, because absolutely the same things happening now. From 2018, we saw a big drop in rates. We did see a rebound in 21-22. That is where the fear was that what if something else happens, right? Because it was a deep retracement in bond yields in India. But we didn't make a higher high, and now we are falling after making a lower high, which is classic Dow theory downtrend being maintained. So if you have an environment where rates are falling, you have government, spending kicking in, you end up getting an investment and consumption boom. And I think we're at the cusp of that. There are variations in terms of where rates are now and where they were in 2002, but broadly, these are all the environmental factors which are same, right? It's not going to be 100% same at the same time, but directionally, they're all the same things happening that have happened before. The last one, and this is really critical, and I think I noticed it early in 2002, not having the idea of what the importance was, because I would be sitting in the institutional desk of SSKI and asking them that the euro's breaking out of a triangle. What does this mean? The euro's breaking out on the upside. There was mostly no answer, because I think nobody really studies macro, gives it so much importance, and only many years later do we understand the importance of the dollar cycles on where liquidity moves around the world. Does it stay relatively more in developed markets, or does it move relatively into emerging markets? Does it create an emerging market boom? The commodity cycle, all of that is fed into by what is happening in the dollar cycle. And globalization has ensured that these cycles can be beneficial to countries that align properly and well with the global monetary system and the global economic system, that is in terms of trade. So what India did post 1990s, getting into that, put us in a much better space in being able to manage through these cycles. Otherwise, we would face the kind of troubles that some of the emerging countries had to face during strong dollar cycles, right? Whether it was the Southeast Asian crisis of the 90s, or whether it was various hyperinflations of the 2010s, India didn't have to face that, because we managed to, align with the global dollar system and the global trade. So, what ends up happening, therefore, when you have a dollar bear market, is you get an emerging market boom. You had a boom not just in EM stocks, but EM bonds and EM currencies. And when the dollar is falling, for whatever reason it may be, the last $3 bear markets have been associated with some kind of a slowness in the US economy. And when that slowness has occurred, the US has been forced to step in, cut rates, stimulate, or expand money, which has ended up then flowing into other parts of the world. This is what we saw between 2001 2008 as well. It's not that post Y2K, once that bear market was over, the US did not attempt a recovery. It did all the way to 2008. But it was always called a slow recovery. I mean, I remember as early as 2005 getting emails about either the yen carry trade that will break the US market, or the housing bubble, which had already popped by 2006, that was going to break the US market. And it didn't break till 2008. Right. So it took a long time, but there was a lot of negative news around the US. However, because the US markets were holding up, the dollar was in decline. What it meant is that money was allocated towards emerging markets relative to US, and there was a boom in the EM and commodity cycle. So if you're hearing that questionability to US markets, right, it's going up and everybody's saying, no, 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 this is a false rally. But if it continues to rally for another 6 months, where do you think that money really goes? And that is, I think, that is the answer. That is why you're seeing a boom or a pickup now across emerging markets, and you're also got signs of the commodity cycle turning. The Bloomberg Commodity Index breaking out to the upside. We look at that chart as well, and overall, essentially, as I listed the rate points out, I was just writing down everything that has happened in the last boom and is also happening right now. The only difference you'll find is something happening a little earlier, something happening a little later, and therefore it doesn't look like history is repeating, even though all the factors remain absolutely the same. And that is how you need to look at this. That is why this is a multi-year boom that started in 2020. Can it last for another 7 years, from 2020 to 2027, putting the same time horizon as the last one? The answer is probably yes. So if a year back I was thinking like maybe 2024, and that number was really based on the dollar bear market having started in 2017. See, I'm not a favorite of time cycles because they sometimes extend. So historically, every dollar bull and bear market was 7 years, 9 years, 7 years, 9 years. I've posted that chart so many times. So this dollar bear market from 2017 should have been 7 years. But the dollar fell in 2017, 18, 19, 20. It was in a range. And then it went up in 21 to a new high. I doubted it for a while, and then 22, it's made a new top. So essentially, the dollar bull market has stretched from 2008 to 2022, making that 14 years. And the next dollar bear market, how long shall it last? I mean, now if I just use the old number again and say 7 years, that gives me 2020 plus 7 is 2029. Here I'm talking of 2027. So I'm saying, well, now we've pushed this cycle forward. Let's see, 2027 to 2029. So that can be the time horizon for how long this is going to go on. Okay. We may think it can happen sooner, but if I look at even the 2021 recovery from COVID, in terms of time, it took much longer than previous cycles have taken from a panic crash. Like even if you go back to 2008, the Nifty took less than 6-8 months to double. You go back to 1994, same thing. You go back to 2001, first rally started. In 2003, it broke out of that basing formation, same thing. So 2021 took 18 months to go up. It didn't do it in 1 year or 6 months. So it's taken longer, which is why we should be prepared for this to take longer rather than happen faster. I know the market's recovery looks very, very fast right now from March of this low, but even if you look at it on a chart, you'll find that the speed is slower than it was from the 2020 lows. So speed slower means we add up more time. Be prepared for it to play out in phases. But the direction, to me, based on this overall big picture, is clearly up. And that's, I think, what I wanted to really get across from these charts. Now, I know a lot is written in the long short report. I hope everybody's read it. But there are a couple of charts that are not there, and I would want to touch upon points since, in the email, we also mentioned that we look at the quantitative cycle, which is really long term. And in the long short, we really like to discuss long term. So some of the factors that you should be aware of when we are discussing long term cycles, one of them is this. And this is the Sensex, which is inflation adjusted. Okay. So when we are talking of an inflation adjusted Sensex, the reason to do that is when we are really measuring the quantitative cycle, we're trying to measure equity or money relative to inflation, relative to your currency, or sometimes relative to gold. Those are the ways that we measure the quantitative cycle. I'll not go into great detail of what the quantitative cycle is, except that it is known as the long wave more often now. And the long wave is a not a time cycle, though it was originally thought of as a time cycle, but it's a series of events that happen one after the other in a particular sequence as an economy expands from a very low point in its life cycle to high growth to high debt, and then the unwind and reset, and then start all over again. And this happens in four phases, which are then named after seasons, which is like, from the bottom of the cycle you start an economic spring, the first wave, then you go into an economic summer. So here's a sort of map of how that looks like. This is sort of a map of what it really looks like, where the economic spring is the first wave of any recovery. Okay. And that first wave essentially comes on the back of uh, government stimulus and low interest rates. Okay. But that spring goes on. As it goes on and growth is very strong, at the end of it, growth becomes strong enough to drive up inflation and interest rates. The highest inflation and interest rates are actually seen sometime over here. As a hangover of this pause. The summer pause is basically because of overheating of the economy. But as it overheats, interest rates and inflation continue to overshoot even as there's a summer pause, and then they peak out and peter out during that phase. So this is where you see peak interest rates, peak inflation. When was peak interest rates and inflation in the US? In the 1970s, right? Or 1984 maybe, max, with Paul Volcker. In India, it was the 1990s, all the way into 1995, 96, where you had peak interest rates. So that is the end of a summer economically. And then you get an autumn. Autumn is driven by low interest rates, everybody borrowing money to spend, buy houses, buy cars, corporate sector borrowing to expand. And therefore, it's an expansion of money driven by credit and borrowing by everybody that eventually ends in a bubble. And then you have an unwind. You need to unwind the debt and raises questions as to how you're going to do this. And there are two alternate paths, which is where people get caught. First path is, let's just default on it. It's not the chosen path. Nobody wants to default. No government wants to announce that I'm bankrupt today. And therefore, the ideal path is to inflate your way out of it, ideally without having an hyperinflation. And in a globalized world, it should actually not be possible to, end up getting a hyperinflation, because global supply chain should ensure that whatever shortages you have in terms of goods and services get supplied, and you don't end up in a hyperinflation, but you will end up with negative real interest rates, which means inflation at a level slightly higher than interest rates, such that it helps to bring down the debt to GDP ratio. Okay, we'll get a little more deeper into that, but this is broadly what the cycle tries to measure. And this top to bottom cycle is essentially almost, originally it was thought as 50, 60 years, but what we are noticing right now, it can go even up to 100 years. It's the events that are important, that follow one after the other, that we should study rather than try to put a time on top of it, because time has failed. The events have not. The events are transpiring one after the other as I observed them over the last 2 decades. So people were trying to call the end of an autumn and into winter even 20 years ago, but the time went wrong. The pattern of events has continued to follow that path. And that is why the other observation I had from an Elliott wave perspective is that waves 1, 2, and 3, long term, over 60, 50, 60 years, is where the spring occurs. Then you have a fourth wave, and then you have the fifth wave into the autumn, and that was just my mental theorization of how this is going to play out. In real time, there will be variations, but this is how I built the model in my mind, so that we can actually work around this in real markets. So when we do that, one of the ways to measure that long wave cycle is to measure it in money. And money, because money causes inflation, and inflation is essentially the expansion of money, which has the side effect of pushing up prices. We look at equity prices relative to inflation, and that then tells us a little about how the cycle is playing out. So when we think of the NPA cycle and whatever happened here, now you think about this. So this is when the last cycle occurred. Okay, theoretically it peaked here at this lower high, but after that it was in a long downdraft, relative to inflation. Even though a lot of the economic sectors bottomed here, they did wave 1 and wave 2, but in terms of the index, it bottomed here in 2001. Now, relative to inflation, equity started to outperform. Remember, equities are the best bet against inflation. How much ever you may be told, because sometimes, when you hear about inflation, it's a scare. It's a scare because, well, it will lead to higher interest rates, and that means we're all dead and stock markets will collapse. But stock markets are the only defense against inflation. Even in a hyperinflation, stock markets go up much more than inflation, and they do better than gold. Even gold goes up because the currency is falling, and gold is a hedge against currency, but equities are a hedge against inflation. And so therefore they end up giving the best ideal performance even in that scenario. There are enough tests done in that. You can Google it, and you'll find equity does better than gold during hyperinflationary periods. So you look for phases. Now there can be a phase like this. Equity did well, but relative to inflation, it did not, purely when we look at an index. However, starting 2020, equity is beating inflation. It's gone to a new high. There's been a long consolidation, and now it's breaking out of this. And when it does, it's going to go a long way. So we are now in a phase where equity is clearly outperforming inflation, and this usually happens when you have a combination of G plus I. Okay, this is important. This is one of the tables that I've put in the long short report. If you get growth plus inflation, the markets really like it, because growth pushes up the markets because of the economic cycle, but inflation adds like a double whammy. You're getting growth, which is demand, and you're getting price rises. You're able to increase prices and pass it on to consumers. The stock market is going to value that positively, even though there can be arguments around margins and so on, because even the costs are going up as well. You're passing on the inflation to consumers, and that gap is your profit. But the market has to reflect price. It has to consider where prices are, because after all, revenue is also a valuation factor, right? You look at things like price to sales, and the reason you look at price to sales is the market sometimes prices itself based on how much revenue you're doing, not necessarily based on your profitability ratios. So that is why when you get G plus I, markets are very, very happy. And I think we are in a G plus I environment. We are not in a G minus I environment, and we are not in a minus G plus I environment, because minus G, meaning negative growth plus inflation, would be stagflation. A lot of people have tried to predict stagflation, but stagflation has actually not been there, at least not in India, because that is the market that concerns us. 2021-22 earnings growth continued to be positive. This is best brought out by a chart of PE ratios. The PE ratio charts show that we are at a much lower valuation range than, in fact, we are at a higher valuation range than we would be otherwise if you didn't have growth. Because earnings kept growing up. So even as markets fell, the PE ratios started to come down, and markets didn't fall so much as we see here. This is a very small decline, but even in this small decline, PE ratios are at a much elevated level. And in fact they've come down despite market being up. Otherwise the PE ratio would be even higher. So at the bottom of COVID, for example, we had a PE bottom of 17 times. Here we have a PE bottom of 18 times. Why is it the same? Even though here at the peak it looked like we had crossed 30 times. Now the reason was that we were not using PE based on consolidated numbers. We are using based on historical earnings. Moving towards consolidated dropped this by maybe 5 points, so we bring it down to 30. But even from 30, if we have come down to 18, the reason is earnings growth. So to say that this was a phase of stagflation, but you had earnings growth pushing up, keeping the PE coming down even in an elevated market, please think to yourself what you're saying. If you're not aware of what is going on, that's a different thing. If you just like to read the word stagflation and feel happy, ignoring that there was actually earnings growth happening during 2022, that would be ignorance at its highest level. So the reason earnings ratios came down, even though markets did not, is because you actually had growth, and because you had G plus I, the markets get support at a much higher level. So this is an important thing to really understand and appreciate, because there are phases in the market where it cares about inflation, and there are phases where it doesn't. So if there was a high inflation interest rate environment here, surely it would have crapped the market. But here we were getting a lot of disinflation. We did get a peak in inflation here, okay, in 2010. We look at that chart as well. So let me just clear this out, and we can go on to other charts. So I've broadly given you a picture of what I think. I think that the last phase, so let us just think in terms of economic cycles. Let me just come back here. This is the economic spring. Okay, this is the summer. high interest rates and inflation peak over here. The highest interest rates in India ever have been seen here. Okay, then you get the autumn, falling interest rates. A lot of NPAs again caused by that autumn is your winter, and now you're trying to spring again. This is how I'm thinking about it. I know in terms of actual Nifty decline, this is very small, and that is where people get caught up. But like I said, there are two paths to an economic winter. One is inflation, and one is outright deflation. We didn't go into outright deflation. Inflation is always the chosen path of governments, and that is why the index relative to inflation is not performing. That tells us that this was the winter phase. It doesn't show up in the nominal Sensex chart or nominal Nifty chart. It shows up in the adjusted chart. So that is why we use an adjusted chart, so that we can understand what these cycles are. Okay. So now in terms of, so we understood that, we've understood what is the debt cycle, right? What is the debt cycle right now? So let's understand this as well. The debt cycle, how it has really unfolded is, you've seen expansion in debt, which is essentially credit. This is government, this is private sector, and then this is total. So what ends up happening is, when government stopped borrowing, so government did its peak here. These are not dates here, this is just the numbers. So this peak is essentially here in 2001. This is where the Vajpayee government really stepped on the pedal. The debt to GDP ratio went from 60 something to 90% at one point of time, and that expansion essentially was aid to the government. And then there were policies here, golden quadrilateral, the power sector policy, and so on. All of this aided the cycle of growth for India. And then after that, we went tight, which is essentially what Keynes had mentioned, that when there's growth, you tighten your belts. Most countries don't do that, but India actually followed the Keynes textbook. We expanded debt when it was needed, and we contracted it when it was booming. But when we were contracting, what was essentially happening is the investment was being done by the private sector, which is why when the government is tightening over here, you see a boom, an expansion in credit from the private sector. And this is a very important factor to really understand and look at. And so this is actually the private sector standalone. This is the total. Okay, there are different totals which are mentioned here. This last one includes even external debt. So I was trying to map whether external debt and everything, if we add up, is it become too high in 2018, when I was thinking we are still in an economic winter because of NPAs. Now that has been taken care of with the NPAs being written off and stimulus for the PSU banks and the corporate sector getting the bankruptcy code and so on. We've done that unwind. We've done what the US did in 2008 in our own way. Our problem wasn't as big as theirs, but both of us had the same problem at different levels, and it was taken care of. Now what you have is, at the depths of 2020, our debt to GDP ratio is again expanded. Now it is dipping a bit, but it has expanded again to 90%. Thank you, COVID. This was thank you Y2K, and this was thank you, COVID. Okay. And the government took that period of tough period to really expand its balance sheet and expand its debt to GDP, so that it can keep the pedal, keep the accelerator on growth. And now what you need is the rest of the things that happened here to follow, which is government intervention in infra. Yes, they are spending 30% more on capex in this year's budget. You need interest rates to come down. They are starting to do so now. Here they came down much faster. They had already come down. Here it's happening with a lag. That is the variation. That is the difference. You have similarities, but those are the difference in terms of the timing. But it is the same thing that should now follow. And what we should watch out for. If the same is not happening, sure, you can always back off. But right now, what we're expecting is the same, because the deleveraging cycle, which can be seen in this chart that I've put in the long short report, which is the credit, okay, measured for corporates in the form of a debt equity ratio, most common ratio that any CA, accounting student, finance student would be taught, has come down significantly from where it was in 2015, right? And especially after 2020. So big decline, which then creates that room that, okay, now if government is spending on capex and stimulating, once we've used up our empty capacity that we built in the last cycle, we will have to invest again, right? And that is what this chart shows. The time has come where the private sector has to start investing again in new projects, which then feeds into the first chart, which is credit, right? Private sector credit growth. which then feeds into the obvious answer everybody should have who understands a bit of money is banking. Why is the bank sector doing so well? Even if there is some pain points in the economy, it's because of credit growth, which comes from this and also comes from the consumer, uh, based on his expectation that rates will come down, or his savings through COVID was the first part, will eventually drive more credit growth, and therefore banking becomes the immediate play, whether it's based on corporate credit growth or whether it's based on retail credit growth. The banking sector benefits the most, which is why it is at the center of and in limelight, as of now. So this is sort of how I look at the whole thing, and then in that backdrop, I add these two tailwinds, which have become the centerpiece for me in the last 6-8 months. I've been every day. I've shown my screen that I have on investing many times, and when I look at that screen, what I end up looking for is what is the dollar doing, and what are the bond yields doing almost every day, both in the US and India. Those are the two factors that I'm continuously watching for, because I'm trying to anticipate, one, that the dollar is in a bear market, and two, interest rates are peaking out, at least for this cycle, and they'll go much lower before they go higher. And specifically in India, I think it's a major interest rate cycle peak. More than around the world, there could be variations because they've already been through the low point on rates. They could get caught in a range, but in India, we might actually see rates go much lower. I know it's hard for a lot of people to imagine how that happens, but time will tell. The charts are pretty clear on that fact. Okay, now this is just a long-term chart of inflation for people who think inflation is the problem. This is CPI. Okay, historical CPI plotted all the way back from the 70s, 60s, whatever data was there. And the reason to see it this way is that when you actually see, this is the 70s here, I think 71, 71, 72. So this is the peak inflation along with the world that was happening. These are various rounds of inflation through the 80s. You see back and forth, even during a bull market in India, there are a lot of cycles of inflation. This is sort of what may be happening in the US now. This is the inflation spike that occurred because of post 2008 stimulus. Okay, and then that continued till 2010, then petered out. Now this is what has happened post COVID. It wasn't so bad in India because US was the biggest stimulant in the world in 2020, 21, right? They were the ones that were spending most of the money. India didn't go so crazy, and neither did China. So the level of inflation problem from a CPI front we are seeing is actually much less than other parts of the world. As much as we may worry about it, surely you want it to be contained. You don't want it to go out of way, but it's not so far not been a massive problem. And if it dips further, it actually creates room for RBI to start cutting rates, which is what I think is coming, which is what I think is the ideal course. I think they're just taking time. They're watching what is happening around the world, but the trajectory is going to be towards lower rates, and the bond market knows this. Okay, here I've put together two charts that I have. One is based on the historical bond yield, because sometimes that is not available, and that I've taken based on RBI's own reference rate history, which they have. Because I don't know, people don't know, will not know, before bond yields got traded and you had these values. You had something known as the prime lending rate, the rate at which corporates would borrow. There was a bank rate which was different from what it is today, the way it worked, and that's what I've used as a historical measure, simply to show where we are in this cycle. So which means interest rates from the 30s. This is the inception of RBI, 1934. Okay, this is the economic spring. India is growing, rates are growing. They keep on going till the summer. This is what I keep talking about. This is the economic summer, 1990s. And then rates start to fall. Somewhere from late 1996, they start falling, and they bottom out somewhere here 2002. Okay. And once the Indian economy picked up pace after that, bond yields also jumped back up. Now, since then, they've been in what I call a B wave triangle, A, B, C, D, E. Now, elitations will understand this. I was just not sure, did E end here? When this bounce occurred, I was wondering whether E is still pending, and, do I need to redraw lines? This was just a thought. But I'm sticking with what I thought in 2018-19, that this was the end of B wave, even though this did not touch this upper line, it got truncated. From here, we see a very clear 5 wave decline. So I'm calling this wave 1 and wave 2 of a new bear market in bond yields for the 10-year GSEC in India. And wave 3, therefore, should take us to levels that none of us will believe today. Even I cannot justify it, because if I say that bond yields in India can go sub 5% on the 10-year GSEC, it sounds sort of close to impossible. But if this is a B wave and we are going into a bear market in yields, which is what should happen in support of an economic spring, then this is and trying to reduce debt is what is happening around the world, because of worldwide that is going to be the pattern. Then there's going to be good reason for rates to really drop in India. We don't have such a big inflation problem. We've already seen that. And you also have some confirmation, because when you really narrow it down, there's a small little triangle over here. And this triangle pattern broke to the downside, and bond yields actually fell to this point here. So this is a confirmation that the downtrend in bond yields has already started with the breakdown in the bond market. And this has happened in April itself. And that is where the market has started to rally. So the market is already anticipating this one part of the story. The second part of the story, which is the dollar, has only started to get confirmed in the last couple of weeks. In fact, on the USD INR, it is still not confirming in terms of breaking the triangle on the downside. I do think it will happen, because you cannot have the whole world in a dollar bear market and USD INR continue to stay where it is. But this chart is a map I've shared many times of the history of quantitative cycles, many past cycles, just highlighting the same pattern that we have discussed here, which is that interest rates always peak in late cycle. Like this is the 1929 cycle. You have interest rates going up till here. Okay. Then they start dropping. This drives this last crazy bull run. And then there's this yield spike during this bear market. And after that, economic spring is driven by low interest rates, then high interest rates, and then highest interest rates again in the next cycle here, which happened over here. And this is the autumn. This is also the autumn. Sorry, summer. This is the summer. This is the summer. And then gets followed by an autumn bull market on low interest rates. The same pattern over and over again. The only difference is the time taken here, and the time taken here is much bigger. And therefore, as a time cycle, it has definitely failed. But I am not a believer in time. I look for events, and this is a very good map of events to really, start off any discussion on this subject. So this is mostly the PPT that I prepared to really get people understand that what we are really trying to think, what we are really trying to look at. Couple of things that I spoke about, which I'll try to highlight in terms of differences. And I'm actually trying to use a chart of LNT here. And the reason I was actually looking at some of these charts yesterday, and I actually saved some of them. So see, I can actually pick them out pretty quickly. Okay. So let me take this on a white screen. Okay. So why I've picked a chart which actually has history from 1990, or I'd actually even prefer a chart that has history prior to that, all the way to maybe 1984 or something, which is there in the old Metastock versions, is that you can actually see the boom bust phases in the cycles for Larsen and Toubro, for example, is the capital goods sector highest weight. So when you see this is the last boom cycle, and then you had this long consolidation phase. Then there was an attempt to break out of this, which led to, in most of the economic sectors, whether it's Reliance, ACC, this is wave 1 and wave 2, most of them. And you had a very deep wave 2. So this has a mental block. It tells us that, oh, you're going to get a deep wave 2. And we set up our expectation that something similar might actually end up happening where after we try to break out of this consolidation. I think this is where the whole mental block is, and I'm going to draw one more line over here, something like this. There's a huge negative event which has driven, this kind of a pattern. And that negative event over here was, of course, Y2K. And here, as we saw, even in our debt cycle was COVID, right? Because after COVID and after Y2K is when our debt to GDP really went up to its highest level. And there was a subsequent, there's a fall in between here, there's a crisis decline. The only difference is that this occurs after wave 1 and wave 2, whereas this seems to happen at the end of the previous cycle, which looked like, okay, maybe this was a triangle A B C D E, in which case E should have ended here and we should have gone up. Prior to the after the tax cuts that were done by our finance minister in 2019, I was actually wondering if this is the case. And then COVID happened, right? So when COVID happened, we ended up getting this where we are redrawing this range, which essentially then puts us at the same point as this. And which is what explains that why this bull run has been pretty much one-sided. This wave 2 here is very small. And a lot of people get caught in the idea, oh, we didn't get a wave 2, so it's going to collapse. It doesn't have to. Okay, this just doesn't have to happen. And the reason for it is because that collapse based on a major global event has already happened in COVID. So what is going on really right now is a bull phase, and a bull phase usually when it is very strong doesn't have deep retracements. Look at this over here. Is this a deep retracement? Well, it was sharp because of the 2004 elections, but in terms of retracement, well, it did 50%. Okay, in Nifty we did see a deeper cut over there, but it's not necessary. When we look at channels, you notice that this retracement is after a very sharp rise, so it looks like nothing. And in terms of size percentage, it may be the same because in fact this is smaller. Okay, but it's sufficient is what I'm trying to say over here. Is when you look at this, and this is also a more than 38% retracement. Okay, it almost reached 50, but it didn't here. It was a little more than 50. However, now that it has resumed, what I would do is I would draw a similar channel as I have done here. And I would think that capital goods, I'm generally trying to say capital goods as a sector, we don't really give advice because I'm using a chart which has a lot of history. We don't have a capex index chart that goes all the way to 1990s. So I'm using this as an example only. Okay, we are not investment advisors. We're not trying to say anything would happen with Larsen. But in general, we use channels in Elliott wave analysis. We would expect prices to move to the top end of the channel and continue like they did in the last cycle. So we've already broken out in many of these cases in individual sector charts out of multi-year ranges. So therefore, to start believing that these things are not true or they are not happening is where all the fallacy really lies. So here's another chart. This one I've saved from an old Metastock version, so it's not really updated. But the reason I did is you have data from 1984, just to show you long-term channeling and cycles. Now this is what stock and what sector. This stock was originally Sesagoa. Now it is Vedanta, right? And so it's gone from being only in what was Spongion to now being almost having every other commodity sector built inside it. But being a commodity sector, so it because it has all the commodity sectors in it, whether it's oil, metals, and so on. I think of it as a commodity index. Important thing to understand is there's a cyclical boom phase, there's a cyclical down phase. Okay, this is a cyclical sector. It has an up phase, it has a down phase, and even on such a long term channel, you see long term channels fitting very well. Okay, so that is the point I wanted to highlight, that it doesn't matter what type of time horizon you have, and these cycles happen. So once you have this kind of a down cycle, another up cycle starts, which we have seen because Vedanta has already reached or crossed this previous high. And when it is doing that, isn't it in a new cycle completely like the last one? That is the main point I was trying to make here, that cyclicals historically go through this up down phase, and they've done so over and over again. What you don't have is enough historical data. So when you see a breakout in an index, so now if I actually draw upon individual indices, which is sort of what I've actually done in the long short report itself. So everybody who's not been to the site, it's a very simple desktop navigation. Okay. So every sector chart here, when I've shown, whether it's the auto index, whether it's the metal index that has already broken out to a new high, right? Since we are looking at metals in terms of looking at Sesagua for the metal cycle, these are all start of new cycles where this is just wave one, wave two. We got three, four, five to go. Okay, so if I open the metal index, take a white environmental chart here just to give people perspective. When you're breaking out of something like this, to believe that, oh, this is all that is going to happen and it's over, is underestimating what happens in such cycles. When you start a new cycle of this magnitude, this pullback is only a pullback to the breakout point, and then it's a continuation of this trend, which is eventually going to do all the legs. It's going to do a 3, it's going to do a 4, it's going to do a 5, and by the time 5 is complete, I have absolutely no idea where it's going to be. But definitely my imagination based on history tells me that it should be far, far higher than where it is right now. That imagination is really, really important. If you didn't have that imagination in 2001, you wouldn't have been able to imagine the last bull market. And believe me, I joined Sharekhan in March of 2001. 6 months later, 2 days after September 11, we were the first on the retail front to write a report saying the worst is over, it's time to get invested. And I had to get my institutional desk to write us a report because we didn't have a full blown research team, and they just gave us a note which we had to put our own stamp on it because nobody wanted to say buy right at the end of that crash. But we thought that that was the right thing to do, and I thought at that time, for same reasons as I did in 2020, that we've ended a 7-8 year cycle. And at least I had one advantage then, that in many of the core stocks, sectoral stocks, actually had waves 1 and 2, including in Reliance. So if I actually open a chart, a long-term chart of Reliance, okay, just to tell you what I'm trying to say, and I'll switch to a white background. I know my wave counts are there that some people want to see, but which we can, which is essentially that wave 1 and wave 2 were already done, not just in Reliance, but in ACC, in cement, in many sectors, many core sectors had already done 1 and 2. Some had not, some had. And what that really meant is that in 2001, at the end of the Y2K bubble, these sectors were ready to start what is 3 and 4. Right now, we know that this is 3 and 4 because fourth waves are typical triangles, and this is a long triangle over here. And then we've started a new phase from here, which I'm again marking as 1 and 2. And again, back then we've looked at this chart. If I actually drew a channel back here and said, oh, this is the top end of the channel is at around 2000, and price right now is 400, and somebody would say 400 to 2000 for Reliance, that's fourfold. It makes no sense. Now you haven't reached the top end of the channel, but you've already reached 2000 something. So that's the beauty of wave analysis and channeling techniques that we go in depth in the mentorship programs if somebody wants to learn, or through those videos. But the idea is that that I'm trying to portray here is that those things work, and sometimes the numbers change, because now that we are here, I have to think, oh, is this just 3 and 4? Is 5 still not complete based on the wave study? But in the big picture, what happens is that because we see the market in cycles, okay, and because we are trying to compare history, going back to the main point of this report, the moment of truth and the comparison with 2001, is that everything doesn't happen exactly in the same pattern. You go up, you go down, and this wave 2 here is essentially happening at the end of Y2K in terms of the end of a bubble. So we start thinking, shouldn't the same happen here? But it did. You got a second wave here at the end of COVID. Okay. And that is where the similarity is. But we are trying to expect a deep correction here because the US went through a tech unwind in 2022. So was that a necessary requirement? And once we were already in this phase, then there was no deep retracement. There was one correction here, but nothing like this. Okay, nothing of that magnitude in terms of both price and time occurred. And that is what we start thinking about those things, because we are making comparisons. We are trying to judge whether the peak of 2021-22 is similar to Y2K because valuations were high, tech stocks were looking bubbly in the US and they were unwinding. And does that then mean that all this is going to fall apart in a similar way? And would that also then mean that sectors like metals, where we were saying it's wave two, will actually get a deep wave two? I mean, it's not a wrong expectation to look back at the metal sector and actually think that would have ended up being a deep wave two. Here we are looking at metals again. Shouldn't this have done a deep second wave over here, doing a 61% retracement or something? But actually, if you look at it, many of the metal stocks have done 61%. Metal index did 50%. Isn't 50% sufficient that you need to wait for 61 or more? So there are sectors that have done it, there are sectors that have not, but it didn't go back below this breakout point, which is actually a strong sign rather than a weak sign. To keep thinking that no, this wave 2 should also do an 80% retracement because many stocks did 80% retracements in 2001 is where the fallacy comes in, to believe that it can play out in a different way because the crisis is not as big as the last one, and the mega crisis was really COVID, which therefore becomes the comparative point with Y2K. It's already happened. Okay, it's not due to happen, it's already happened, that big shakeout of weak hands. And now uh, you're actually in a completely different stratosphere. Okay, another variation ends up happening with the dollar index itself, right? So when we talk about all this macro, we talk about, okay, the big picture, fine, India, all the key sectors have broken out, they're in bull markets. They were at the end of 7-8 years in 2020, and even in 22 we are only at the end of a second wave, so starting third, huge moves left. But what about the dollar? It behaved so differently. Okay, so fine, we open the dollar index and we look at the 10-year cycle. Look at what really happened in this phase. Okay, why did we get it wrong? Now again, I'll switch to get it wrong, get it right, but where are we right now? That is more important. So only applying a time cycle, like this lasted for 7 years, so okay, this should last for 7 years. So based on that time cycle, I said, okay, maybe this is the peak for the dollar in 2018, which also matched with a bottom in gold. So it actually was sort of a confirmation. Oh, great, gold has bottomed out, the dollar has peaked, so possibly I'm right. The dollar starts a 7-year bear market from here, similar to this. Okay, so you have had 9-year bull markets in gold before and 7-year bear markets. Okay, and so I think, okay, you'll have a 9-year bull market in the dollar, and it goes from 2008 plus 9 is 2017, which is here, perfect timing. And metals bottom out and rally, so it makes you feel you're right. But just because it made a new high in 2020, does that mean that the dollar is in a new bull market? So you step back and assess. I mean, wave counts can change, but that doesn't mean that there's a change in the big picture. So when I look back at this big picture, what I end up marking now on the DXY is, instead of just ending it in ABC, I ended it in WXY. I take this sideways pattern where the dollar was flat and metals did well for a while as X, and then Z. Okay. Now, the beauty of intermarket analysis, classic Dow theory, was what? Charles Dow mentioned that if the transports makes a higher high, but the industrials does not, then it may be a false signal. Okay. Now, that theory extrapolates itself into multiple time frames, short term, long term, to take similar types of views. And that's one kind of analysis which helps me verify that, yes, Z is indeed over. Now, let me explain. Between 2017 and 2020, most commodities, which is this phase, most commodities bottomed out, starting with gold in 2016, ending with oil, copper, silver in 2020. They have all bottomed out here. So when you got this decline in the dollar, okay, here, okay, while it was only a part of an X, what did you get in commodities? You got wave one. Now, when the dollar went up to a new high, what should have happened? Like during this entire phase, every time the dollar went up, commodities crashed to a new low, but not over here. So, when the dollar index hit a new high, commodities only did a retracement. Oil did almost a little more than 50%, copper did 61.8, aluminium did 78, okay, and so on. None of them have gone back to a new low. This is a massive intermarket divergence between 2017 and 2022, which further confirms that the dollar is topping out. Because if the dollar was really not topping out and going to shoot up, commodity should have been in a bear market that will take us to new lows. That is not happening. What is happening is commodities are doing wave 2 and getting ready to start wave 3 up in a new bull cycle. And that can only be true if the dollar has finally completed Z and has started a much anticipated dollar bear market, which this channel shows, because you have WX, YX, Z, all overlapping legs, everything is overlapping and ends in Z. The fifth wave is usually Z, 1, 2, 3, 4, 5, and that is usually the end point. And that's where people were max bullish on dollar. The global positioning in dollar, long dollars, was the highest ever on record. Okay. I can't put it in better ways that this was a point of maximum sentiment in terms of the dollar. This also felt like that, but this definitely felt even more like that because of the sheer sentiment on dollar going up and people feeling that this is the end of the world because of the dollar and because of US inflation. That psychology itself tells you that this is a major turning point. And this is very important, the dollar, because every dollar bear market like this last one, remember I was talking about this ending pattern we were breaking down from on the dollar, and the euro was breaking on the upside. When it did that, you started a long dollar bear phase. Here you don't have an ending you have a small one, you have a small triangle on the daily charts, but what I was waiting for is a confirmation that this is 1, 2 and 3, because 2 could have gone higher, and it did in case of the JPY. In terms of the CNY, you've seen the Japanese yen retrace 78% of its losses, but not the dollar index. And now its dollar index has broken its lows. Another way to look at these things is take cross rates. So I study a dozen cross rates every day just to see whether the thesis I'm trying to paint actually shows up in many of the others. And one of the interesting cross rates to make that judgment was actually the British pound. Okay, so if you actually open a chart of the GBP, see, I'm continuously trying to switch to the white charts. All my markings I always save in black charts because I find that easier on the eye. The USD GBP over here, the British pound, okay, was in a rising trend, very similar pattern, looks like a wedge or a triangle. It's essentially, you can mark it ABCD, you can mark it WXYZ, but basically once you have completed E or you have completed Z, okay, so either this is E or Z, then you have started a downtrend in the USD GBP, which means the pound is getting stronger. And this is leading the way. If you see this, it broke this low much before the dollar index. Dollar index only broke now. So the British pound was sort of, and this was the intervention when you had the insurance sector crisis. Dollar was rising, bond yields were rising. They had to bail out their sector, in September of last year. That's exactly when the dollar topped out. So the British pound by nature, therefore, became the first currency to start strengthening after that bailout. Okay, and became the lead signal that the dollar is in the process of topping out. Nobody is going to let it go up any further from here because it is not in the best interest of any country. India sold $100 billion worth of its reserves to protect its currency. So what more can you say? So everybody is standing up against the rising dollar, not going to let it happen. That's a pattern you have to understand, which is not in the best interest of America itself either. Okay, so important to get that in your head. So we have multiple reasons from different angles to think why the dollar has topped out. I'm trying to convince the people who are still not convinced based on what we call technical market analysis, or what I call complete market analysis, looking at every factor from every angle to have all the answers, because I need to have the best answer that nobody else has, not being caught up in narratives and false talk, which is all over YouTube. And maybe sometimes because of lack of knowledge or depth, whatever it is, or lack of belief in systems. You can believe in one system, fundamental, but you can actually decry the technical theory and analysis like the ones that I've just shown you, and that unfortunately can lead you to miss out on things that you don't respect or give importance to. I respect every part of market analysis. I just believe that each has its role and has a methodology and a way around it, and therefore should not be misinterpreted. That's about all I try to highlight, including when I turn a little bit negative on Astro. It has its application as well, but not the way most actors make you believe that it is. So I'm even highlighting that as a fact, that a lot of market analysis is wrong in its methodology and approach. That doesn't mean I'm always right on market, but I'm just saying that approach and use of methodology is critical. Otherwise, it will keep you on the wrong side of that approach unnecessarily for a prolonged period of time. I believe in using everything together. So I'm not the believer of only this science or only that science, only fundamental, only economic, only technical. I believe that they are all connected. Elliott waves allows us to connect fundamentals with a stock, economic cycles with the market, and sentiment with what is going on overall. And if I have all of that, then why not put it all together? You'll have a much better view of things and much higher accuracy, both on the big picture and the small picture. So moving forward, we have a confirmation from the dollar. We have a confirmation from Indian bond yields. The USD INR remains the last baby waiting to break. But if everything is showing weak dollar, eventually USD INR is going to break on the downside. So I have no doubts on my INR view. Breaking on the downside. The only thing I'm doing is in terms of calibrating what. In fact, this is also a long-term bull market. Just to tell you now, let me take it to a yearly chart. This is also a 1, 2, 3, 4, 5 trying to complete. Okay, and at the end of the fifth in the yearly chart, which has different subdivisions on a lower time frame, where I actually think now that this is 3 and 4, not what the yearly shows. Okay, this is a running triangle fourth, and this is a fifth. And this triangle, which is over here, I know somebody asked in the comments yesterday, what do you think about triangle being fourth? I can either, you are asking me the obvious answer. If this is a triangle fourth and USD INR goes up, market goes down, uh, either you want me to give you the answer you want to hear, or you want me to tell you what I think. So if this is a fourth wave triangle, blah blah blah, yes, you already know the answer, so then I don't have to tell you that. What I think is, it's not a fourth wave triangle. I think this is a fifth wave ending diagonal, ending pattern. Even though it's not rising upwards, it is sideways. It is a sideways triangle, just like we saw in the bond market, bond yields. If you haven't seen the chart close enough, let me show it to you. Sometimes people have actually not looked at charts in proximity, and I've actually published only the long-term chart. So you may not have seen it. This is the last 1 year bond yield chart at the bottom. I've zoomed it. You see a triangle, A, B, C, D, E, very, very clearly. Okay. And so when you see this A, B, C, D, E, what do you really think? A, B, C, D, E. Now you would say, oh, no, this is a bullish triangle. It's symmetrical. It should be a fourth wave. But it has broken the downside and gone here. Now you cannot say that. This is an ending pattern at the end of C. It's A, B, C, D, E on the top, with E at the top at the end of a C wave, okay, in a large ABC counter trend. And this is 1 and 2. We are starting down now, early stage of starting down in 3. Bond yields in India will go to around 6.5% in the next 6-8 months based on this, from where it is around 7%. Now, next question, people say, तो bond fund ही लूँ क्या equity के जगह? Now, see, I have typically personally not been a bond investor. I look at bond markets because to get my other views right. So I can't really decide on how much equity to debt allocation you should have in this scenario and what would be the returns. If you have an investment advisor who can help you with that, you go and ask that. My job is only to look at the chart and figure out what is going to happen. What is the right allocation and how you should benefit from it is very, very individual, because each one's risk reward portfolio is very, very different. You have to do a KYC with your advisor, and then only he can give you advice on something like this. I am not in that position, and like I said, I am more of an equity guy than a debt guy, but I do study these markets because it's important in terms of factoring it into my overall investment model. Right, so we have a triangle breakdown. We are getting a similar triangle in the rupee, and I'm waiting for the rupee triangle breakdown. Right, once it breaks, I think around 81.7585, this low around 75, or the weekly 40 average around 6560. So once you break that, that 10-15 paisa zone over here, then you're clearly going to be in the dollar bear market for the USD INR as well. So USD INR would attempt to go back to the fourth wave of lower degree. It won't do that in one shot. It's something that takes years to happen. Believe me, because look at this, the last dollar bear market. If you have not seen it, look at this, how slowly it happened. It was like a I don't care moment. You couldn't really trade this. If you even did a short USD INR position, be moving down so slowly, you would be bored to death. So to expect, this is go down to the fourth wave, it's not going to happen like this. Not necessary. It could be really, really slow. And given that if this is 1 and 2 and this is 3, what if this is a triangle? So it could be a lot of ups and downs. I don't know what the pattern will be. I'm just saying that for now we can think that this near 83 we are topping out. And once we break the lower line, it will confirm. And then we'll watch what the pattern ends up being. Will it be a triangle? Will it be a complex pattern, WX, YXZ? I'm not sure what will be the structure. But the worst case right now we would think is this line. We may not see the rupee strengthening below 71, 72 in a worst case scenario. That's the objective I'll start with. It can always change. It can always change to this lower level. But we'll start with the first one first and take it from there. So the only, I think, now we have couple of confirmations. The USD INR is just waiting to happen. One more, which I think is almost happened, but at the same time feels like on the edge, is the US bond market. I do think US bond yields have peaked. They're waiting to fall. I know the Fed meet is in the coming week, and some people are banging the table and saying rate hike, even though inflation data has been falling, and they have said very, very clearly that economic data is not their reason to raise rates. So if you're looking at, oh, unemployment hasn't gone up, therefore they'll raise rates, they are very clear that's not going to be the reason. Okay. And if it is, they would have to justify, right? Why on a falling inflation data are you really raising rates? You have to justify when you have said in the last 3 meetings, we don't target economic data point. So I think it's again, it's like not listening to the Fed kind of narrative. So my sense is this meeting is what will trigger a bond rally and a dollar decline even more than ever before because of what he is going to say or how he's going to say it or the market's interpretation. My interpretation is that the most recent fall in bonds, that is rise in bond yields, was essentially the last. It is some kind of either a double top in bond yield or just a wave to a higher bottom in the bond price. And it already started to go up here. I think this will continue. It's going to go into a third wave. We are just waiting, for the Fed speak to aid this recovery. I think in the bond yield, and longer term it will end up looking like, in some cases, a double bottom. Okay, the weekly RMIs, for example, might already be in a bullish trajectory or bullish mode. I can check on that. Let us see. Let me just plot the weekly RMI for the US bond yield, because that's the last part of macro that I think will keep us on the right side of everything that I'm saying. That is falling bond yields, falling dollar, and emerging markets, specifically India, takes off, to the stratosphere. So we don't have a confirmation on weekly charts for the US bond yield. So it's so funny. Indian bond yields are confirming, US bonds are not. US dollar is confirming, Indian dollar is not. And those are just minor things which I think will eventually confirm. We need to watch out. But the biggest trigger to me, the falling dollar, is what I'm taking as a sign that we have, and Indian bond yields as a sign that we have crossed that line. It's pretty much confirmed in my mind. You're already starting to see a reversal in commodity prices and the emerging market index. So let's look at those two, which are essentially the signature for this. This is Bloomberg Commodity Index, and there's the EEM. Okay, that must be under a different folder. Yeah, and then as I opened this, let me even highlight this sector index. It's called the KBW Bank Index. It's a US bank index. It has been used for years to promote the idea that US banks will fall apart. Even then, they went back above the 2008 highs a bit. Okay. More recently, I've used it to take a call that US banks have bottomed out. You can already see them going up after the recent results. The reason for that call was very, very simple. I just marked ABC on this chart, where C is exactly 5 waves, as I'm showing you right now, and C is also equal to A in terms of size, A and C. In short, when an ABC correction is over, US banking crisis is over. Okay. If you're still waiting for the next US bank to collapse and the world to follow that, you're writing your own collapse. Okay. So don't do that. This is what Elliott Waves tells you. ABC, bear market in US banks is over and it's already recovering. Okay. The US bull market is getting more broad based with the participation of banking and the participation of the small stocks from the Russell 2000. It's already happening. Okay. So I'm going to focus more on the markets that interest us from an India perspective. First is to know that yes, emerging markets are coming back. So this is the EM index. It retraced 50% and then has been making higher bottoms because various other markets, except for I think China, which is still near a 60% retracement point, forming some kind of triangle. So I think China is the only odd guy pulling this index down. Every other market is starting to break out, whether it's Taiwan, Thailand. They've all started their moves. It's only China, and in China also have started to like and look at the China A50 index instead of the Shanghai Composite. It just has a cleaner chart in terms of the 5-wave advance. So actually, I can look at that on investing because I have these screens. Okay, so this is the China A50. This is the first one that should reckon us to start thinking. This is 1, 2, 3, 4, 5 perfect 5-wave advance. You can see this in the Hong Kong Shanghai index. You can see it in the Hong Kong IT index. All you have ended up getting from wave 1 is wave 2. And at the bottom of this, there are only two possibilities. One is to touch the lower line and go up, or second possibility, which I've drawn on this chart, is this is a triangle. Once this triangle is complete, we break out on the upside. Wave 2 means that news around China will be bad or even worse than it is over here. So when you make a higher bottom on news that is as bad or worse than it was at the bottom, this was COVID lockdown, okay, and this is despite COVID lockdown, China is going to get into trouble. That is the news today. So when the news is bad or badder than it was here, it confirms wave 2. It gives me super confidence that this is wave 2 and China is going to explode in wave 3, which means China must be about to do a stimulus or whatever they'll do. I don't care what they'll do. China stocks are going to go up in the next 6 months. Doesn't matter. They may go up less or more than the world. You can have that relative argument. I'm not a relative trader. But if you need to get this argument out of the way from the emerging market index, well, it is the best one, most obvious one that it's China is not coming to the end of the world. Now, so that takes us to emerging markets. Emerging market is very simple. It's 1 and 2, and then it's trying to emerge from there because China's pulling it down while others are pulling it up, and so you see a slow advance, which will I think gather momentum because China has almost a 40-50% weightage. Will gather momentum only once China starts to participate. Okay, and in the big picture, just like I spoke of, we saw Y2K. We have actually seen a deep wave 2 in the emerging market index. So this is very, very interesting because some of the emerging markets have actually gone through deep cuts and now started to. So we actually inside a third wave, and then within that done 1 and 2 and trying to take off. Slowly but steadily, I would expect this to take you very, very far. Okay, this is what is going to happen, and that's the signal that we are getting over here on this chart. And the next becomes commodities. So commodities have slowly but surely broken out of from this downward pattern I've drawn over here. Again, let me switch to a white chart so you can see it better. Okay. What happened with commodities is that it went through a bear market from 2011. Okay. And like I mentioned sometime back, that bear market ended here in 2020. For most of the stocks, including oil, only gold bottomed here, okay, in 2016, but everything else bottomed in 2020. And from there, they've all done wave 1. This is what has caused the massive intermarket divergence. And at the end of wave 1, as we always say, there's a triangle, there's an ending. Well, here's one more. This is at least upward slanting. And then it broke down in wave 2. And now we are starting wave 3, which is already being signaled. I think the weekly RMI might already be bullish looking at this breakout. Okay, we already broken out of this. You can draw it this way or you can draw it this way. You can do triangle or you can do, I'll do WXYZ. I'll not call it a triangle. It just visually looks like that. It's not even overlapping from here. So I'll call it WXYZ. And then from there, we have probably done the initial 1 and 2 and starting to do 3 up. starting a third wave. So the commodity index being led by a bit by oil this time, surprisingly. The base metals I thought would lead, but they've still been lagging. But we've broken out of this. So you can run the RMI, which is a very interesting confirmation indicator. I'm sure this one has confirmed on the weekly, just like, see, even the dollar is confirmed on the weekly. Okay, the weekly dollar index RMI is in sell. The weekly RMI is in buy mode for the Bloomberg Commodities Index. And so then we end up looking at the monthly. And in monthly, we actually see that it has come down to the bottom end of the range, from the top end of the range, taken support at the 40, broke the 40, took support near the band. The cycle is complete in terms of the RMI coming all the way back to zero, taking support on this line, should eventually start off in 1, 2, and 3. This is what we are looking for. Follow-up question is already the obvious: if commodities go up, won't inflation go up? Few people have lived through the 2008 commodity bull market, when inflation didn't go up, when oil prices went up multifold. But still, this question around commodities comes up without having actually looked at that last bull run in commodity prices. So, uh, commodity index went up how many times, and still you didn't have 15% inflation. Why? Because I mentioned in the beginning, globalization, supply chains. This year's inflation is really, I think, if you put it in that context, is really supply chain, right? Global supply chains breaking down due to COVID was really the problem, and then excessive pent up demand. And once all of that normalizes, why should you have hyperinflation? It doesn't. The reason doesn't exist. The only reason for inflation is that government is spending more today than it was doing last time, which they need to manage by not expanding monetary policy too fast. I think that's sort of the game for the Fed in the US. As long as they can do that, you will not ignite demand to a point where inflation needs to skyrocket. And the commodity price might not have to do so much with it, because that's just an input price. And so if you can manage that game, you can manage inflation at a higher but not too high level, then it creates an environment, what we call a Goldilocks environment, which is not just for India but for most global markets that depend on things like that. You will not get multiple rounds of an inflation problem like you did in the 1970s or 40s. Okay, so that's not a necessary outcome. It is possible. You can even go through the 40s type cycle, which is what I've written in the long short report, that you can get multiple rounds. I've tried to play with the idea that yes, this is what will happen. That is the expected pattern, that you get multiple rounds of inflation, which is why I've shown that inflation chart. uh, I think, yeah, this one. So this chart, the reason for me to show this chart was essentially that if you do something like this, like the 40s, where the government is spending and the Fed is keeping rates low, you can have many rounds of inflation, control it, then another round, and each time you try to control it. At the end of that deflation or disinflation, you get a mild recession, which you got in 45, then you got in the late 48, 50. But none of those mild recessions really caused a big stock market sell-off. They just caused a retracement of 23 to 38%, and then that bull market went on. And so if that is the case, then that's probably the worst case scenario, that you have multiple inflation cycles. But that only means that the market moves up in stages rather than one way, which you can see if you simply open the chart of S&P 500. Okay, if that's the sense you want, you open a chart. Okay, open a 100-year chart of the S&P 500 and look what happened during these inflation cycles, late 30s, for early mid 40s, all the bear markets that occurred at that point of time. Okay, I cannot see so much data here, so I'll just go to DJI. Yeah. So when you see those periods, they're essentially, I'm going to highlight them on this chart where those periods are. They're essentially here, okay, here, here. These are the recessions that you actually see on this inflation chart. Okay. So this gray areas are essentially what I have marked on my meta stock chart. So if that's the case, we can move ahead in that format as well. Okay. And in that sense, then the current wave looks very, very similar, right? Because it's actually done nothing more than just dip a bit because of inflation. It's a very small dip, which compares with these type of rounds, you know, which is the game plan, which was the original game plan, was really to bring down the debt through inflation, right? With what was coined as modern monetary theory. It's very simple math that if you can live with not too much inflation in when you're actually trying to do a theory based on what is it? It's called debt, okay, and you divide it by GDP. Okay, debt is the numerator, GDP is the denominator. All you're trying to do is increase GDP. If you increase GDP, debt goes down, and you're increasing nominal GDP. So when you're increasing nominal GDP, it's a function of growth plus inflation. Okay, so it's not only growth. If you get inflation, also nominal GDP goes up, and if you can get a combination of both, it goes up faster, and your debt to GDP ratio comes down. Now you need to do that without really triggering a debt crisis, interest rates that are too high to repay or uh, what do you say, refinance your debt, you know. And so that's sort of the game, you need to keep trying to play that. As long as you can play that, you can go through a period like the 1940s. I think that's in a nutshell the environment. I think I'm pretty clear in my mind that the thing to focus on, of course, is India, because I am here. I want to invest in core sectors. The environment broadly is favoring a reflation and a boom across cyclical sectors, which have started to outperform, and a few new sectors that have become big, which is manufacturing and defense, and the breakout sectors, which is power, capital goods, real estate, metals, oil and gas. And that is where I would focus for most of the gains. Of course, there can be other outliers, individual companies that are doing something, but this is just the broad sense of where I think the bull market is going to be and the factors that are going to drive it. And I hope, I thought I'll only talk for half an hour, but it's so difficult when I try to cover everything. I end up talking longer than I even believe I can. So I hope I've not bored everybody. We'll move to questions, Chavan, because I'm sure there are a lot of them. Hopefully, I've answered
Yeah.
half a dozen of them along the way. But
Yes. Yeah. Am I audible, Rohit?
I can hear you.
Yeah. Wonderful presentation, Rohit. Rohit, before we start up the Q&A, if you can go through the Strike platform and showcase the analytical tool, that will be great, and then we can open up to the Q&A, please.
Yeah, for everybody who's not yet taken a look, and for those who have, uh, this is something that you're going to get addicted to once you use it. Okay. uh, Hats off to Chavan and the team with him for putting it together in terms of the way the screens are. I know the first time a lot of people look at it, they start wondering, what do I do here? Because we've designed it in such a way that you don't really have to scroll here and there looking for information, and it's very easy to really zoom into any particular segment if you click on this zoom in zoom out, and it gives you a different feel of you gives you a deeper look at that particular segment, and it even gives you certain additional menu items to further sort inside this and look at different ratios once you go inside a segment. So that is the beauty of how it is designed. Plus, at the same time, you can open different tabs from the left. These are the main menus. Okay, so how do you come here? First step, if nobody's come here, it's just web.strike.money. That is the URL, web.strike.money, right? Strike. So Strike is the platform that we are calling it. And once you come to this platform, you need to sign up just once. Right now, it's a login free that gives you a 50-day starting trial, because we are in the process of launching many more modules than the ones you're seeing right now. These are most of the technical and sentiment modules that are live, along with some market data. What will come live also is going to be futures, options, fundamentals, economic data, maybe even later, and a lot of other things which will just keep getting added over time. Next, give us a month, and within a month, you'll see, dozens of more tools, setting up themselves up here. But the nice thing about this is going to be that once you open a particular tool from this left hand menu buttons, if you open the bulletin board or you open the sentiment indicator, what will happen is it will open up on the top over here. And moment it opens up on the top, okay, if you go to a particular segment, you have the menu items to play around with, and we have very nice scrollable interactive charts for you to be able to see data, not just the latest but historical. And that's what I like about sentiment, where I can actually compare what FIs were doing. If they were long today, how long were they the last time the market topped out or bottomed out, and data points like that which are not easily available. You can find the latest data on NSE website, but can you see the entire history and be able to judge where you are and what you're doing with a chart? Similarly, I don't know anybody who has breadth charts. I've been keeping them for 2 dozen years, 2 decades, 3 decades almost. And we will give you the entire backdated year. Right now, it's till 2012. So you'll see it all the way to 2000. And look at the 20-day, 40-day breadth ratios, so that you can see how these ratios are really working along with the market. So very, very interesting stuff that is not there, along with heat maps, and not the traditional heat maps. These are customizable heat maps, so you can actually run performance tables from different time horizons, different performance ratios, and across sector indices and baskets. Okay, so you can choose any basket that you want to particular run it on, and actually see what the performance was like today, 1 week, 1 month, or on a particular time frame. So a lot of things. I'm not sure we can go into each and every one during this session. But what I would call you out for is go to the left hand side, click on each of these menu items, and then see what we have over there. Like this one I've been posting about recently, which is how many stocks are above the 200-day moving average. And I tried to do that on a 500 Nifty 500 basket, which is a broad basket. So when you do a broad basket, the number is at 79%. Is that relevant or not can be seen based on how it behaved in the past, right? So no data is relevant unless you can see history, right? History repeats itself. No, but it rhymes. And so you have to study history and see how it behaved in the past, be able to draw similar conclusions from the future. Gives you a much better standing in the market. And that's what we've tried to do here with various types of tools and various forms of market information, which is just at a click away. You can know the calendar, upcoming calendar for various companies. You can even just type it and you see how quickly it actually shows up on the screens. So go ahead and try it out. My RMI indicator is also here for those who've been waiting to look at it on different platforms. Some people have said, why not another independent platform? So here we have it on an independent platform completely, where you can see the RMI at the bottom, the trade setup that we use, the Bollinger Bands averages on top, and a scan over here of which stocks are giving buy and sell on the RMI. So you can actually drill down to where the new signals are. You want to see where the new buy signals are. You want to see it across the Nifty 50 only, on a live market, or based on yesterday's closing prices. You can choose accordingly. So a lot of things. There's a Dow trend scanner also. This is the last one I'll leave you with, which scans stocks in Dow theory up and down trends. Dow theory is the classic higher highs, higher lows, lower highs, lower lows, and allows you to scan across stocks which ones are showing you which signals, again with a filtration of which are going up and down as you may want. Chavan, I think I should leave it there unless you want to add anything more.
Yeah, and just in case if you're not able to understand what how to understand this, we already have info videos. Rohit, if you can click on that, yes, absolutely. We have this help menu section just next to the time. If you can
Yeah.
show that,
So
please.
this is the help menu. So if you don't see this help tab, you just click on this button. This help tab opens up, and you have videos across different tools, which we'll keep adding to, along with doing the live sessions of the tool, which we are putting on YouTube as well. So you can track all of that.
Okay. So, guys, go to web.strike.money and check out, sign up, and you will get a 50-day free trial. Okay. Okay. With this, Rohit, if you can start off with the Nifty and Bank Nifty analysis, and then we can open up the Q&A. So, again, I repeat, it is web.strike.money.
Yeah, so I deliberately did not go into detail of what you just said, Nifty, Bank Nifty, because I wanted to get the market outlook through. Nifty, so what we are really saying longer term is that we are starting to count a fresh wave from the COVID lows. That is how I want to think about it, which means that I'm actually marking this in line with the sector charts where you're done 1 and 2. I'm trying to mark this as 1 and 2 and 3. This is what is my preferred thought of what is going on, because I believe something has ended with this COVID phase, like we saw on the relative chart of the Sensex, and this is what makes sense. Without going too much into history or what it is, what this really means is you have a third wave, you'll have a fourth wave, you have a fifth wave. This is a long way to go. It can last, like I said, up to 2027. The third wave itself, if it is equal to the first wave, can end up at 35,000. So that is the objective with which we'll work. Doesn't mean that the third wave can't extend. History has it does extend. Like, for example, you see here, this is the first wave and this is the third wave. So third waves do tend to be, if not equal, then 1.618 times the first wave. But problem is today, even if I say 35,000, people will say pagal aadmi hai. So let's first start with that. And then we can always adjust as the waves subdivide. We will be able to make adjustments along the way as to what is happening. Now, if I do something similar for Bank Nifty, okay. So Bank Nifty is also similarly interesting
No,
and has
we
already
are
got
actually
two
having a long
subdivisions.
shot.
We already have two subdivisions. We have 1 and 2 over here, and then another 1 and 2 here. So somewhere we are in 3 of 3 when I think of Bank Nifty. Unlike Nifty, I have not taken this entire phase as a WXY pattern. This entire phase. In Nifty, what I've done, I've taken the whole phase as 2. In Bank Nifty, I've taken as 2 1-2s. We'll see how that goes and sort of adjust itself later on. But this is the marking that I'm thinking of. Note this again here, this entire phase, whether it's 1 2 3 4, these are all thoughts. Whether you take this as 1 2 3 4 or something else having concluded in 2020, what I end up doing is from here I'll start marking it as a fresh impulse on the way up, and we'll figure out the backdated counts as we go along. So yeah, last thing first is, yeah, if this is equal, what does it look like? Close to around 80,000, which is again a crazy number. It's not even 50,000. If the third wave is even equal to the first wave, you get a number which is over 80,000. Chavan.
Yes. Okay. Uh, what about gold and silver, Rohit?
Yeah, so I would actually push a lot of people to go and read each of the outlooks. Otherwise, I'm going to be spending 3 hours only telling what does each and every chart look like. Uh, Very shortly, if I'm saying we are inside a commodity bull market, that includes gold and silver. Okay, so gold and silver are likely to remain in a bullish trend. That's like the basic point. Numbers in terms of calculations and discussion we've put in the long short report itself. I really would urge people to read that. Uh, but to get a sense of the wave count, for those who've not seen it, it's something like this right now. So my fifth wave right now, the top end of the channel is itself around 2700. And I don't know, fifth wave will be equal, will it be extended? Or is this even fifth, or this is a further subdivision of 1 2 1 2? We still have many more to go. Chavan?
Yeah. Okay. Fine. So let's come back with the questions. Okay. Rohit, Prabhat wants to know your USD JPY view, please. Those who are live on YouTube and live on YouTube, you can start asking your questions. Those who are live on Zoom, please come up with the questions, please.
Yeah, those who are in Zoom can raise your hand, and I think Chavan can take your questions from there.
Let's start with some of the questions on YouTube.
There's a chat
So the
bot
first,
over there. You can just raise and you can ask your questions.
so Rohit, the first question we have from Prashant Desai. He says, "What will be impact on pharma and IT and other export-focused sectors in
Okay.
India of this USD INR playing out?"
So the last time USD INR was flat to down was again 2001, 2008. Did IT stocks do well? They did average. They didn't go down. They definitely went up. They just went up less than the growth sectors of that time, because the growth sectors were really moving up much more rapidly, whether it's in infrastructure or capital goods. And so that's something to understand. You'll have to be in the IT sector, you'll have to be very, very stock specific in your choice, because globally there is an IT boom, which again cannot be ignored. And there is a lot happening around AI, a lot of business happening around it. So companies that adapt and manage to grow their businesses in those areas definitely do much better than others. So your choice there becomes important. I don't think the same business model will work. That's the broad thought. So, but you cannot have this thinking that rupee gets strong, IT stocks will not do well. If your investment in IT stocks is only a rupee play, then definitely that's a bad IT stock. Or if it's only a labor arbitrage play, then it's a bad IT stock. You'll have to go beyond that, is the simple answer.
Okay.
On JPY,
Rohit,
let me just answer your JPY question. See, on JPY from 2011, we have completed a larger ABC, as I'm showing over here, where the B wave was essentially a triangle. Okay. So now what you're going to get is start of a new impulse down. Then this B wave is just the initial point, which is around 100 that you need to get back to. So from wherever we are right now, at least let's get back to 100. We will then try and map what that next leg down looks like. Is it an impulse or is it just going to be another ABC and then up? We don't know. But right now, I would think the trend is down. Yeah, shoot.
okay. Yeah, okay. Nifty IT
The
view,
next
please.
question
Nifty
we
IT
have.
and pharma. And of course, Prashant wants to know what will be the impact on pharma and IT and other export focused sectors in India of this if dollar INR playing out.
No, I think I've answered the dollar INR question already.
Yeah, this is done.
Okay.
Let's move
So
to
what
the
will be the
next
impact on
question.
pharma and IT?
IT, I think, is already answered, Chavan. And
Okay.
one thing I'll mention is between pharma and IT, these are defensive sectors. They do very well when nothing is doing well, like we saw in 1990s and we saw that in 2010s. Now they will do well, but they will not do as well as others. That's about my short answer. Every sector has bottomed out. This is a bull market. In a bull market, you cannot have market go up, pharma go down. That doesn't work. But you will have pharma going up much less than everything else.
The next question we
Okay.
have from
The BSE
Equinomos.
metal index looks like it has formed a triangle and just broke out of
I
it.
think Nikhil, that Chavan cannot hear you only. Anyway,
Okay.
Okay, anyway, let's continue. The next question is from Equinomos. Where are we in Nifty IT?
I think that's answered.
Okay, let's move to the next question.
Okay. What is your
Nagpur Shah.
favorite sector presently?
So the sectors that I've mentioned here, and I will just add defense. Okay, these sectors, these are people who've not watched the entire presentation, I guess, are mentioned over here. Whether it is defense, capital goods, power, oil and gas, metals. Now, metals has been my historical favorite. It's right now not moving. I think as the dollar thing gets more constructive, commodity cycle is just about to take off. So I think metals will start showing super performance in the next quarter. The others that are already showing that are anyway good. Okay. So I cannot put a finger on a single sector. I'm sorry, but if I had to, I would put it on metals, and you will not be happy right now till it picks up.
Okay, in case of a booming economy, what would be the impact on small retail banks like Bandhan Bank and so on?
Everyone does well. All banks do well in a growing economy. There is no two ways about it.
Okay.
Except avoid junk, and I don't need to explain what that is.
Okay.
Any
Rohit,
not
if you can, yeah, if you can
hmm.
just cover Bank Nifty wave count, that would be great because you just
No,
covered only Nifty.
no, I covered Bank Nifty wave count. Please see the recording. I'm not
Okay.
doing it again.
Yeah.
I'm going to be clear. We cannot waste time. We have limited time. Let's go to the next question.
Okay.
So Nagu Gupta
If Fed
asks,
stops raising rates now and inflation relatively controlled, do you think US markets enter summer period, then followed by autumn period later?
I didn't get your question.
The question from Mr. Aditya is if the Fed stops raising rates now, okay, and inflation relatively controlled, do you think US markets enter summer period and then followed by autumn period later?
No, summer is something which comes after spring. We are only at the end of winter. So you can only get spring. Spring can last for 20, 30 years. So you do understand contractile cycle is a multi-year analysis. So if you ask a long wave question, it cannot be, oh, summer after winter. I mean, this year summer, next year winter. It doesn't work that way. Winter can last for 10 years. Spring can last for 20, 30 years. We are starting spring. We are at the end of winter and trying to transition into spring. It's a multi-year process of bringing down debt and growing the economy.
Okay, and this is a question on Infosys, Rohit. Have you ever seen Infosys ever reduce the guidance so much?
Yeah, I got infamous on that when I was in Sher Khan in 2001. We had a bearish call on Infosys and they reduced their guidance. The stock hit 3 circuits down.
Hmm.
This time it doesn't seem to do that badly. And subsequent to that, every time around results, the volatility you see around Infosys results started since 2001. It became a pattern. But yeah, that is the last time they actually did that. And after that, the stock bottomed out in 3 days, and that bottom became the bottom for the next 2 decades.
Okay. And what will be the this one on your view on PSU sector, Rohit?
Very bullish.
Okay.
The
If you
PSU
can
sector
share.
chart, yeah, I'll open the
Hmm.
chart. The PSU sector chart, as I was mentioning in my talk earlier, is also breaking out of a multi-year pattern. I'll take the BSE PSU because that has more history. Okay, so here you have the PSU index chart. This is the long consolidation. Now it is breaking out of this. It's almost reached its previous 2008 highs. Okay, barely a point of, I mean, it's pierced through it temporarily. I think in a day or two you'll be above it. And once you're through this level, basically it is in line with what I think is on every index, what I'm doing the same thing. 1 and 2 and 3 has started. So again, there's a smaller 1, 2, 3, and there'll be a 4, and so on. So these are multi-year trends. You have to compare it with this kind of a phase, okay, which goes on and goes on for many years. So you draw a channel, extend it to the upside, and you expect this to go on. In the channel is currently at 18,000 or something, and that's still not the third wave being over.
Okay. Do you see any reason for going back to bearish views if interest rates are increased or hold high for longer term?
So I don't like these type of questions, and I'll tell you why. The question is like this, usually posed like this, that if all the factors you're thinking are bullish, if they all turn bearish, will the market go down? It's like the obvious answer with an obvious question. The question really
Hmm.
should be, Do you think that can happen? The answer is no. I don't think rates will go up. So the question is useless in the first place.
Okay. Your views on PSE sector, please, Rohit. This is a question from Mr.
PSE,
Apur.
PSE and PSU are the same.
Seen. Okay. Okay. Any more questions, ladies and gentlemen? Please start
So,
throwing up.
Nikhil,
Yeah.
you had something.
We had some questions from YouTube. So let's start. Um the most recent
Okay. There's
question
a
is
question
by
from
TR Raghavan.
Sriram.
He
I'm just
asks,
going to unmute him. Sriram, you can ask your question, please.
There's no voice coming, right?
Yes, Sriram, go on, go on. Yes, yes. Rohit, Rohit, were you able to hear the question?
No, I can't hear anything.
Okay. Sriram, if you can just post a question on the chat bot, it will be great. Okay. Rohit,
Okay, I can hear
yeah,
him. I can hear him now.
okay.
Hmm. 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 So it takes us back to the thing whether history repeats itself or it rhymes, right? So when you look at why I use this chart, okay, this chart pretty much tells you where the melt up is and where the crashes are, and where we mistake one for the other. Now, if I just look at this, this is Harshad Mehta, and then this is after that 1994. Now, I'm not sure whether you'll call 94 a melt up. In some ways it was, in some ways it wasn't. Okay. Because the peak of the cycle in some ways was 94, where maximum investment into mid caps and IPOs went. And then it petered out after that. Now you also have this, and some people would want to call this Y2K also as a melt up. Then this means that this entire bear phase had three melt ups, which are even lower from each other. So this 2008, you are willing to believe that it is a melt up, but this you are not willing to believe it is a melt up. So I think the most important melt up is here and here, which is the peak. Now, again, having said that, this peak comes at the end of a major run in mid cap. So there was a melt up of some kind, but it was in the mid cap space. So if we look at a chart of BSE mid cap, okay, this to me is also a kind of melt up, because mid caps were seriously outperforming compared to Nifty. Now, if you look at this chart and say, no, this is not a melt up, but this is a melt up, How do we define it? So then another way that I started to monitor this is relative performance of mid caps uh, to the large caps themselves. Now here I cannot go to a white chart, but this chart I've dated back even till 2008. A year it may not be showing because of some history missing, but we've posted charts before. Essentially, what ended up happening here, let me just take green as a color. Yeah. So this would have started somewhere down here. Okay. Now, each of these peaks, essentially, when you say melt up, is when mid caps have significantly outperformed the large caps, whether it's here, whether it's here. Okay. And now here, there's actually some people will say 2021 was a melt up. But when you look at this, it's hardly a melt up on relative performance of mid caps. And it was far lower than where we were in 2020 as well. So the last melt up in relative performance of mid caps to large caps was actually over here in 2018. So yeah, we have to find some way of measuring the market's internal madness.
Okay, next question is from Kumar Gaurav. Kumar, you can unmute. You can ask your question, please.
So this is again an if and but situation, that I have to somewhere believe that the market knows something that I don't know, and then follow that model. Now, yes, things do change. There are times we have changed our view, and that is our job, to stay on top of things and see whether something is changing or not changing, and whether that change is having a definitive impact on our view. To give you an example, 2 years ago I thought the dollars was already in its bear market, and that was fine because markets were going up based on what I would expect in a falling dollar environment where metals are doing well and equities are doing well. Then all of a sudden the dollar started to go up. So should I change my view now because the dollar is going up? Now, simply put, I didn't. For almost 6 to 8 months, I didn't, because it was having no impact. The dollar was not having the kind of impact it should have in either bringing down equity prices or bringing down the commodity cycle. And so we ignored it for as long as we could. And then when prices were still under pressure, we went with the bearish view for a while. But the fact is that it didn't play out that way. So you have to really weigh these factors long term based on what impact they had. It is very easy to get carried one way or the other. Ki ye hoga to ye hoga. I know we all want a simple answer. But that is why now what do I have? This chart which I was showing of, say, a Larsen and Tubro on the chart. I have to ask myself this question. Is the market lying to me that the stock price is at a new all-time high? Or does the market know something that I don't know? I mean, it is broken out of a 10-year range. And I have to answer this question. And this question is across sectors. Like, it is not that it is only happening in capital goods. It is happening in capital goods, metals, PSU, banking. Now, if you have half a dozen sectors breaking out of their last congestion zone, going into new all-time high. But I'm trying to tell myself, no, this is a bubble, something will change and something will go wrong. Then I cannot participate in this market. So how do I answer your question and get the right answer is the real thing.
Okay. Rohit, your view on the insurance sector, please.
So we don't have an insurance sector index, but if I simply look at the pattern of some of the key insurance stocks in the sector, okay. So what we have seen in the pattern of most insurance stocks now is see what have I opened. But I do not want ETFs. What is happening? तो ये सब ETF ही दिखा रहा है. एक HDFC. Okay. So in what I can see in almost most of the insurance stocks, only taking this as an example, is that compared to the COVID low, this low is higher, and they have done either a 60% or an 80% retracement. Okay. So the only easy thing for me to do over here is right now, for the time being, mark this as 1 and 2. There is no history. We cannot know what the past is like. But based on the limited price action, this is the only thing we can do is mark 1 and 2 from the COVID bottom to the recent bottom. And then anticipate that, okay, 3 is going on. And then see if anything changes till that point of time. But I think I see most of the insurance stocks I've seen have the same pattern where they've had a pretty deep retracement of the gains, but made a higher bottom.
Okay. Rohit, the Q1 results for the Nifty stocks, apart from banks, it seems to be bad. So, if full year Nifty EPS will see downgrades, then how do you see this bull rally in all this?
No, I don't think without having the full quarter's earnings, we can answer that question properly. Because if the overall Nifty earnings grow at even 15% for this quarter, then it's a different scene. So some numbers are bad, some numbers are good. Most of the bad numbers are coming from the oil and gas metal space. But the good numbers are coming from financials, right? You have Kotak and ICICI and everybody reporting 40-50% earnings growth. So you need to see the overall number at the end for all the sectors. And unless you see that, rest is guesswork. If earnings come down, will the market come down? I mean, what kind of question is that? It's like the answer and the question is the same.
Okay. From a risk management angle, Rohit, if how much percentage of investments do you reduce if, in case your view changes? How do you manage risk?
This is a half an hour to 1 hour mentorship session question. But the simple answer will be you need to use some long term tools to really judge whether the trend is breaking. In your particular stock, 20 portfolio, you use some tool of trend, whether it's a long term moving average for that stock. Okay. Some stocks will break it, some will not. That's what happens every time. And that is where you think of reducing weightage. I would not only use one tool, I will use four or five and give them weightage. So if I give weightage to each tool, as each another other every tool starts to confirm a trend reversal, I would reduce to that extent. That is one way of dealing with it, because nobody really likes to sell all his investments long term. You want to reduce and increase the weightage based on what is happening in the market. So you build a toolbox that tells you, okay, this is not confirming, this is not confirming. 20% of the tools or 30% of the tools are not confirming. So I can reduce the weightage by 30%. That kind of action can be taken to manage risk.
Okay, we'll take up couple of questions from the Zoom platform. Abhijit Ghosh, you can unmute and you can ask your question, please.
Yeah, I
Yeah.
can hear you. So, see, in my view, it is not only liquidity based. Liquidity is definitely a very helpful factor in propping up markets, but governments around the world are supporting this growth through their own spending programs on infrastructure and capital. And this is not just India, this includes the US. I was just listening to an interview just yesterday, which was explaining how a lot of spending has already been committed, towards building. In the when they went, they had this they had this spending budget on a non-inflationary, disinflationary basis. They came up with a budget to spend on certain things. Now wherever that spending is and goes into hundreds of billions of dollars, it ends up stimulating growth in certain areas, which is why if you look at US market, see, people don't do an across the board look at even the US. If you simply go at look at cross sectoral, so I have done an all indices kind of chart on investing, and you open things like US industrials, you look at US oil and gas, you look at US materials index. Okay, those are all making new highs day after day. Okay, so if you do a Dow Jones basic material index, you'll see a slightly different chart. If I take a if I take a chemicals chart in the US, it's very, very different, getting elevated. Some of them are actually rocketed. I'm just trying to find which ones, but you'll find them if you actually scan through, each of these. Like the automobiles and parts index has actually done better. Now, what I'm trying to highlight is what is happening is that spending across different segments of uh, the market has actually led to uh, a much broader, participation and improvement in the economic activity. So it's not only liquidity. That is my main point. We shouldn't just think that this is only a liquidity driven rally. That is not the case. And in India, same thing. Capex spending by government was up 30% in the budget itself. So it was already indicative that budget towards capex and defense is already there, and then that spills over into everything from metal, cement, and other construction activity that goes around it. Like I've shown a chart of, in my presentation I've shown this chart, right, where corporates are committing a lot more in new projects. Now as this project spending kicks in, what happens?
Okay.
Can take more from Zoom, Chavan.
Yeah. Okay. So USA with US with every increasing debt, do you think it will dollar index model will fall apart? What will happen to the dollar index if there is an increasing debt in US?
See, let's put it in a different way. Let's not go so far as trying to predict what will happen in non-predictables. Okay, there are a lot of unpredictables out there. It will be really tough to know what is the impact on debt, how they're going to manage it. But the simple answer is they're going to attempt inflation, which is what they're doing, which is try and keep some inflation, try and get some growth, and bring down the debt to GDP ratio. Okay, that is what is going to happen. So you think the debt will go up, but if there's inflation and there's growth, the debt to GDP will come down. The value of debt doesn't matter. What matters is what is going to be the debt to GDP ratio. Okay, so all the policies right now are working towards doing that.
Okay, fine, Rohit. So in the meanwhile, let's continue with the Zoom session, but we'll have to end the broadcast in StreamYard
Okay.
because taking up the questions here, they'll not be able to hear over there. So if you can just announce in StreamYard that we are ending the session because they're not
Okay.
able to hear me. So yeah.
Yeah. Okay. Okay. So essentially, what we are doing is we are ending the live streams right now, which are running on YouTube, Twitter, and so thank you all for participating in the live streams across our platforms. We are going to be, probably posting these recordings later on the India Charts platform for people to watch. We will continue with the Zoom session, so people who signed up for Zoom can join us there for additional Q&A, and we probably end this session by 12:30. Right now it's close to around 12 o'clock. So that is it. Thank you all for joining us from various platforms.